Here's a sentence that should genuinely unsettle anyone who thinks crypto exchanges make money by betting on crypto going up. This business can make money even when the entire market is crashing. In fact, some of the most profitable days in this industry's history happened during total market panic, prices collapsing, headlines screaming disaster, everyday investors terrified. And the exchange sitting quietly in the middle of all of it was having one of its best days ever. Here's why. A crypto exchange doesn't need the market to go up. It doesn't even need the market to be healthy. It just needs people to keep clicking buy and sell, and panic makes people click buy and sell more than almost anything else. The exchange isn't betting on crypto, it's betting on chaos in either direction. Today we're breaking down the real economics of owning a crypto exchange, because underneath the charts and the token logos, this is one of the strangest business models in modern finance. A company that can profit from total market destruction, that doesn't need to own a single coin to get rich off of coins, and that can lose everything overnight from a single security breach, no matter how much money it made the week before. Let's start with the fact that reframes this entire industry. A crypto exchange often makes money even when crypto prices are falling, because trading volume, the sheer number of buy and sell orders flowing through the platform, can stay extremely high during volatile, even catastrophic, markets. Think about what this actually means for the exchange's incentives. A calm, boring market, where prices barely move, is, in a strange way, one of the worst outcomes for an exchange's revenue. Nobody feels urgency to trade. Nobody's panicking, nobody's chasing a rally, nobody's desperately trying to exit before further losses. Volume dries up, and so does the exchange's core income. But a wild, terrifying crash, the kind that destroys retail investors' savings and dominates the news cycle for days, is often one of the best days an exchange will ever have, purely because fear and panic generate an enormous surge of trading activity. People selling in terror, people trying to buy the dip, people trying to time a bounce, all of it runs through the exchange's order books, and every single one of those transactions generates a fee. The exchange isn't rooting for crypto to succeed or fail. It's rooting for movement, in whichever direction people are scared or excited enough to act on. Here's the actual engine underneath almost every dollar this industry earns: trading fees, particularly what's known in the industry as maker and taker fees, charged on both spot markets and derivatives markets. Individually, these fees are genuinely tiny, often a small fraction of a single % on any given trade. It sounds almost trivial when you hear the number in isolation. But here's the part that changes everything. Multiply that tiny fraction across an enormous, constant, global volume of trades happening every second of every day, and that tiny sliver becomes one of the most reliable, massive revenue engines in modern finance. This is exactly why the core model of this entire industry can be summarized in one simple phrase: take a small cut of huge volume. It's not a business built on making large, risky bets and hoping they pay off. It's a business built on being the toll booth that every single transaction has to pass through, collecting a small toll each time, regardless of which direction the traffic is actually moving. Here's a layer of sophistication most casual users never think about. Crypto exchanges can monetize both everyday retail users and large institutional players simultaneously through entirely different fee structures tailored to each. A casual retail trader making occasional, relatively small trades might pay a standard, higher percentage fee on each transaction. A large institutional trading firm, moving enormous volumes on a daily basis, will typically negotiate down to a much lower percentage fee, sometimes dramatically lower, specifically because their sheer trading volume makes them valuable to the exchange even at a steeply discounted rate. This tiered structure means the exchange isn't just running one business model. It's running two, layered on top of each other. A higher margin, higher fee retail business that generates strong per transaction revenue but lower total volume, and a lower margin, high volume institutional business that generates comparatively thin fees per trade, but at a scale that can still produce enormous total revenue. The smartest exchanges design their entire fee schedule specifically to capture value from both groups simultaneously, rather than optimizing for just one. Here's a revenue stream that exists almost entirely outside the trading activity itself. Listing fees charged to new token projects that want their coin available on the exchange's platform. This can function as a major one-time payment, a recurring fee arrangement, or sometimes both. And here's the detail that makes this genuinely strange compared to traditional finance. An exchange can earn substantial revenue from a token before that coin has ever traded heavily, simply by charging the project behind it for the privilege of being listed at all. In this sense, the exchange isn't just a marketplace. It's also functioning as something closer to a launchpad, and that launchpad role can matter just as much to the exchange's revenue as the actual trading market that develops afterward. Think about how unusual this is compared to, say, a traditional stock exchange, where a company typically has to meet substantial financial and regulatory requirements before it can list shares. In parts of the crypto industry, a new token project can pay directly for exchange visibility, essentially buying its way into a marketplace in a way that would raise serious eyebrows in more heavily regulated traditional markets. Here's a category of revenue that's individually forgettable but collectively significant: withdrawal and deposit fees. Each single fee here is small, often just a few dollars, sometimes even less, and no individual user is likely to notice or care much about a fee this modest attached to moving their own funds in or out of the platform. But multiply this small charge across millions of individual users, making withdrawals and deposits constantly, around the clock, across every time zone on Earth, and this becomes a meaningfully significant revenue line, even though it barely registers as a cost to any single person paying it. This is a recurring pattern throughout this entire industry's economics, worth noticing as a theme. Almost nothing here works by extracting large sums from any individual user in a single transaction. It works by extracting small, easily overlooked amounts from an enormous number of users, repeated constantly at a scale most people never stop to add up in their heads. Here's a quieter revenue mechanism that most users never notice at all: the spread, meaning the gap between the price at which you can buy an asset and the price at which you can sell it on the same platform at the same moment. An exchange can quietly widen this spread beyond what pure market conditions would justify, effectively marking up the buy price slightly and marking down the sell price slightly compared to the true underlying market rate. The user experiences this simply as the price, with no visible fee line item anywhere in their transaction. But the exchange is capturing a small margin on essentially every trade that flows through this gap, invisible to anyone not specifically looking for it. This is exactly why comparing crypto exchanges purely by their advertised trading fee percentage can be genuinely misleading. An exchange advertising remarkably low headline fees might simply be making up the difference through a wider spread instead, moving the same revenue capture into a place that's far less visible and far less likely to be scrutinized by an average user comparing platforms. Here's why margin and futures trading products occupy such an outsized position in this industry's revenue. These products often generate disproportionately large fees, simply because the traders using them tend to trade far more frequently than typical spot market users. A trader using leveraged futures products isn't making one occasional trade a week. They're often opening and closing positions repeatedly throughout a single day, reacting to price movements in real time, adjusting exposure constantly. Every one of those actions generates another fee, and the frequency alone can make an individual active futures trader worth dramatically more to the exchange's bottom line than a much larger number of passive, occasional spot traders combined. This is exactly why exchanges invest so heavily in building sophisticated, appealing futures and margin trading products, complete with charting tools, leverage options, and real-time data feeds. It's not primarily about serving a niche audience of sophisticated traders out of goodwill. It's about cultivating the single most valuable category of user this business model has, the one who trades constantly, regardless of which direction the market happens to be moving. Here's a revenue category that operates almost entirely separately from trading activity: staking, lending, and yield-generating products. These products let users earn a return on crypto assets simply by holding them on the platform rather than actively trading them. And the exchange itself typically captures a share of that yield as its own revenue, functioning in a role that looks remarkably similar to a traditional bank, taking a spread between what it pays depositors and what it earns lending that same money out elsewhere. This creates an entirely additional income stream that doesn't depend at all on trading volume or market volatility. Even during a genuinely quiet, low-volume market, an exchange can still generate meaningful revenue from users who have simply parked their assets on the platform in a yield product, earning a modest return while the exchange quietly earns its own margin on top of that arrangement. It's a way of monetizing users who aren't actively trading at all, turning idle assets into an ongoing revenue stream almost by default. Here's a growth mechanism that also happens to be a genuine revenue source in its own right: affiliate and referral programs. Users who bring new traders onto the platform typically earn a percentage of the fees generated by the people they refer. On the surface, this looks purely like a marketing expense. The exchange is essentially paying commission to acquire new users, the same way any business might pay for advertising. But because the referred user keeps trading indefinitely, generating fees for as long as they remain active on the platform, this marketing spend can end up producing far more total revenue than it ever cost to acquire that user in the first place. This turns what would normally be viewed purely as a customer acquisition cost into something closer to a self-funding growth engine, where the people doing the marketing work, existing users spreading the word to friends and followers, are themselves incentivized by an ongoing cut of revenue, rather than being paid a flat, one-time fee the way a traditional advertising channel might work. Here's the single most important vulnerability sitting underneath every revenue stream we've just covered. This business is unusually, perhaps uniquely, dependent on trust, because one significant security failure can destroy user confidence almost instantly. Unlike many traditional businesses, where a single bad incident might dent a company's reputation gradually over time, a major security breach or a credible insolvency rumor at a crypto exchange can trigger something closer to an old-fashioned bank run within hours. Users rushing to withdraw everything they have, all at once, terrified their funds might not be there tomorrow. If the exchange can't process that surge of withdrawal requests fast enough, or worse, if the funds genuinely aren't fully available because they were used elsewhere, the entire business can collapse in what feels, from the outside, like an instant. This is precisely why trust functions as this industry's single most valuable and most fragile asset. Every other revenue stream we've discussed, trading fees, listing fees, yield products, referral programs, all of it depends entirely on users believing their funds are safe and accessible. The moment that belief breaks, even temporarily, the entire revenue engine can seize up almost overnight, regardless of how profitable the business appeared to be the week before. Here's a self-reinforcing dynamic that explains why the biggest exchanges tend to keep getting bigger. Liquidity itself functions as a product. Deeper order books, meaning a larger, more active pool of buy and sell orders sitting on the platform at any given moment, naturally attract more traders, because deep liquidity means large orders can be executed quickly without dramatically moving the price. And more traders arriving on the platform naturally deepens that liquidity even further, creating a reinforcing cycle where size itself becomes a competitive advantage that's genuinely difficult for a smaller exchange to break into. This is why new exchanges entering this industry face such a steep uphill climb, even with a technically superior product or dramatically lower fees. A trader executing a large order cares enormously about whether that order can be filled quickly and cleanly without significant price slippage, and that capability depends almost entirely on how much liquidity is already sitting on the platform. A newer, smaller exchange, no matter how well designed, simply can't offer that same depth until it's already attracted a substantial trading population, which is precisely the chicken and egg problem that keeps the largest platforms so dominant. Here's a cost structure that's grown dramatically as this industry has matured. Compliance. Operating licenses across multiple jurisdictions, ongoing legal review, regular security and financial audits, and continuous regulatory reporting requirements all represent genuine, recurring expenses, not a one-time cost paid at launch and then forgotten. As regulators around the world have grown increasingly serious about overseeing this industry, these compliance costs have grown right alongside that scrutiny, and they show no sign of leveling off. This creates a genuine structural advantage for larger, well-capitalized exchanges over smaller competitors. A massive global platform can spread the fixed cost of building out a serious compliance function across an enormous revenue base, making the relative burden manageable. A smaller exchange, or a genuine new entrant trying to compete, faces largely the same absolute compliance costs, the same licensing requirements, the same audit standards, but spread across a dramatically smaller revenue base, making regulatory compliance alone a serious barrier to entry in this industry today, in a way it simply wasn't in the industry's earlier, far less regulated years. Here's a distinction that matters enormously for anyone evaluating this industry from the outside. Operational costs can consume a genuinely large share of total revenue, meaning the headline revenue figure an exchange reports can look dramatically more impressive than the actual profit sitting underneath it. Beyond the compliance costs we just covered, exchanges carry substantial ongoing expenses in cybersecurity infrastructure, customer support staffing around the clock across every time zone, technology development, and insurance arrangements meant to cover at least some portion of potential losses from security incidents. All of this sits between the impressive top-line trading volume and fee revenue figures that make headlines and the much less publicized bottom-line profit figure that actually determines whether the business is thriving or merely surviving. This is exactly why raw trading volume, the number most commonly cited when comparing exchanges, can be a genuinely misleading way to judge how healthy or valuable a given platform actually is as a business. Two exchanges can report similar headline volume figures, while one operates with disciplined, efficient costs and genuine profitability, and the other burns through nearly everything it earns just keeping the lights on, the security systems running, and the regulators satisfied. Here's the strategic insight that separates the industry's most durable, dominant platforms from the ones that struggle to survive a downturn. The strongest exchanges consistently win by combining multiple revenue streams simultaneously, rather than depending heavily on trading fees alone. An exchange relying purely on spot trading fees is directly exposed to trading volume collapsing during quiet, low volatility periods in the market. An exchange that's also built meaningful revenue from listing fees, yield and staking products, futures and margin trading, and referral-driven growth has effectively diversified its income across several genuinely different sources, each with different sensitivities to market conditions. Meaning, a quiet spot market doesn't necessarily mean a quiet quarter for the business overall. This diversification is precisely why the largest platforms in this industry have expanded so aggressively beyond simple spot trading into yield products, derivatives, token launch services, and beyond. It's not simply about growth for its own sake. It's about building a business resilient enough to keep generating meaningful revenue across every phase of crypto's notoriously volatile, unpredictable market cycles, booms, busts, and the long quiet stretches in between. Here's the idea that ties this entire video together. An exchange doesn't necessarily need to own crypto at all to profit enormously from crypto's existence. It can earn purely from the flow of orders and services moving around that activity. Think about how different this is from the common assumption most people carry about this industry, that exchanges are essentially crypto speculators themselves, betting on the same coins their users are trading. In reality, a well-run exchange's core business model looks far more like a toll road operator or a casino running games with a built-in house edge than like a fellow trader placing directional bets on price movements. The exchange profits from activity itself, the buying, the selling, the staking, the borrowing, the referring, largely independent of whether crypto prices are rising, falling, or going nowhere at all. This single distinction is exactly why an exchange can remain highly profitable through market conditions that would devastate an actual crypto investor holding coins directly. The exchange was never really in the business of betting on crypto's future value. It was always in the business of collecting a toll on however much activity that belief in crypto's future value happens to generate in either direction. Let's return to the fragility we touched on earlier because it deserves its own closer look. Reputation risk in this industry is unusually concentrated compared to almost any other type of financial business. A single hack, a credible insolvency rumor, or a significant regulatory enforcement action can change this business's entire economics overnight. Not gradually, the way reputational damage typically unfolds for a traditional company, but almost instantaneously as panicked users rush to withdraw funds and trading volume collapses in real time. There's very little buffer, very little gradual warning period between thriving, highly profitable platform and existential crisis, and the transition between those two states can happen within a single news cycle. This concentration of risk is precisely why the industry's biggest, most established platforms invest so heavily in visible security credentials, insurance arrangements, and proof of reserves demonstrations, not purely out of genuine caution, though that's certainly part of it, but because trust is functionally the entire foundation the business sits on, and there's no meaningful insurance policy against losing it entirely in the span of a single bad weekend. So let's go back to where we started. A business that can profit from total market panic. A business that doesn't need to own a single coin to get rich off of coins. A business built almost entirely on collecting a small toll from an enormous, constant flow of activity layered across trading fees, listing fees, withdrawal fees, spreads, yield products, and referral programs, all reinforcing each other. And underneath every single one of those revenue streams sits the same fragile foundation: trust. One security failure, one insolvency rumor, one serious regulatory action, and an entire highly profitable business can unravel within days, sometimes within hours, no matter how many clever, diversified revenue streams were layered on top of it the week before. This is exactly the kind of industry this channel exists to take apart, something that looks like it's about betting on the future of money and turns out to be a toll collection business with an almost unmatched reputational cliff edge built directly into its foundation. If this changed how you think about the next crypto headline you read, subscribe, because we're just getting started pulling apart the businesses hiding behind the headlines. See you in the next one.